Hello and welcome to this week's edition of the Retirement Compass, the show that helps you successfully navigate to and through your retirement. I'm your host, Kristin Oakley, and joining me in the studio are two members from Stonebridge Wealth Systems. We have the co-founder, Tim Kulhanek, and partner, Jeremy Gove. We've got a great show for you today. We're going to be talking all about risk when it comes to your hard-earned income for retirement and what risk buckets you need to make sure you have in place so that you can navigate successfully through retirement and be confident that you're not going to outlive your money. So Tim, Jeremy, there's so much to unpack with this on this subject of risk.
Yep.
How are you guys doing this week? You doing well?
So far, so good.
Good,
yes,
good.
Doing great. Thank you.
You're welcome. Well, I'm excited. We're going to be sharing some important resources that our viewers can use actually during today's show to help them accurately assess their risk tolerance. And really, this is something that I think doesn't get talked about when we're in the working and saving and accumulating years as much, because when time is on your side, the market volatility is a good thing. When the markets go down, that's a great opportunity for you to buy more. That's how you buy low and sell high, right? But as you approach retirement, risk becomes a lot more problematic, and so you need to be properly prepared for that. And the team of Stonebridge Wealth Systems is passionate about making sure you have the right risk buckets in place for your money. So you're going to want to stay with us to hear everything Tim and Jeremy have to say about this important subject. How do you want to start this off as we think about people's existing portfolios? You know, let's define the risk buckets. I guess we'll start with that, and then what our viewers need to understand about them.
Yeah, as we go through the show, I think we can really drill down into what goes in the different risk buckets. In general, there's three. There's the safety, income, and growth bucket, or growth without risk and growth with risk bucket. But I want to just start by explaining to our viewers, like, what are the different types of risk? Because so many times we hear risk and we think like, oh yeah, the market.
Right.
Well, that's one type of risk. That's investment risk, the risk that the value of your assets may fluctuate. But we've also got things like liquidity risk, the risk that you won't be able to get to the money in a timely fashion when you need it. You've got interest rate risk, risk that interest rates could go up or down. If they go up, your bonds or your fixed income holdings could be worth less. If they go down, then your yields are going to be lower. Your reinvestment risk is going to be impacted. Legislative risk. Right? Obviously, we just saw that this year with the passage of the One Big Beautiful Bill Act. There were some changes. They made the tax rates and brackets so-called permanent, but really they didn't. They wrote it in pencil, but they made changes still. Right? There's phase-ins. There's phase-outs. There's a chance that what you thought was for example, 22% bracket might actually be more like 24.64%. Something we've talked about on previous shows. And today, I think that it's important to take all of those things into consideration when you're designing a balanced, comprehensive approach to retirement. It just so happens that on this show, we're going to focus on investment risk because it's part of what we have to be cognizant of. Yeah,
for sure. I was saying, thinking as you were talking when I was going through all my licenses and all those exams, and you really dive into all these different types of risk. No investment is safe or immune from any type of risk, right? I mean, because if you just put all your money in cash, for example, you're going broke safely. You have inflationary risk. So, yeah, but we need to make sure, and I think there's often a discrepancy between how folks think that they're invested and then actually how much risk they're currently taking. So it's important to know that. And, a lot of times, I think because there's that lack of education and understanding about that, when folks are just looking online at their IRA balances or their 401k balances, and they're checking their statement each month, especially as they get closer to retirement, this can really cause a lot of fear, right?
Oh yeah, absolutely. And a lot of times people will think of an election year that, they think that elections are going to cause a lot of problems. I remember when Trump won the last election, there were a lot of people that had a lot of anxiety about that. And then there were other people that were celebrating it, and so it just depends on where you're at. But we do actually have a slide from an election cycle talking about midterm elections, going back to the legislative risk. You can see that during a presidential election year, the stock actually do really well. The stock market does really well. The typical average over all years is 10.3%. But on a midterm election year, there could be a little bit less of a return. The average is 7.4% during election years. And this slide is provided by BlackRock, and it goes back to 1926 through 2023. So you can see that over that time frame, there's a lot of different variations depending on what's going on. So the legislative risk is real, but it's still going up.
Yeah.
Typically.
I'm glad you called out 1926 because we're coming up on 2026.
I know.
Like, oh, wait a second. But we're talking about almost 100 years of data that support that. So that's important to know. And this trend has continued more in recent history. So just even, the last 25 years, this has held true, right?
Yeah, even since the 2000 presidential election, like the one we recently came off of in 2024, election years have just produced a better return. I think around 7%. That's different from the chart we just showed. That's 1926. I'm just saying the last 25 years, still 7%, so not too bad. Midterm election years, however, have produced a return of just 5.6%. So that's like a 1.5 lower. It's meaningful if you think about the compounding effect of that over a long period of time.
For sure. Well, we mentioned some resources that we want to be able to share with you that you can utilize right now during today's show, completely free of charge, to help you assess where you stand from a risk perspective, and does your current risk tolerance actually match up with how your investment portfolio is currently being invested and managed. So we have this awesome quiz for you that we're going to put up the website here for you on the bottom of your screen, stonebridgeriskquiz.com. You can also get there by clicking that QR code. This is a quick 2 to 3 minute online interactive assessment. What are our viewers going to learn when they visit the site?
I mean, the bottom line is, what is your true risk profile? What are you comfortable with? The number one reason why investors, in my opinion, do not succeed long term and why they vastly underperform the market is because they tend to have a sabotaging effect on their retirement assets, on their investment strategy. Like, I know there's people out there watching this right now who are like, well, was he talking to me? Well, yeah, if after, let's say 2020 and the pandemic, you thought, oh man, I don't want to ever go through that again, and you moved to cash and you've been sitting in cash for the last 5.5 years, there's a lot of people, there's over $6 trillion sitting in cash right now in US denominated money market funds. So a lot of people moved to cash and they just never got back in. Even the ones that seemed like they timed it well, they got out before the pandemic, or they got out before Liberation Day, or before whatever, Black Swan event took place and the market crashed, they still have been sitting where they were. They've been losing money safely, as you said earlier. And yes, the market went down and maybe they avoided a little bit of pain, but they've given up so much of the upside. So that's why guys like Peter Lynch say far more money. Peter Lynch, famous fund manager, right? He managed the Magellan Fund. He averaged 29.2% from 1977 to 1990, the Fidelity Magellan Fund. He said one time that far more money has been lost waiting for or trying to time a bear market than in any given bear market at any time in history.
Isn't that interesting? Because the markets are so reactive, and if people are responding on fear, I mean, we've done other episodes where we show if you jump in and out of the market, usually the best performing market days are right after the worst market performing days. So you're going to miss out on that upswing.
And that's why you need a portfolio that's designed to go through these types of swings. So I actually have a picture. I think it's kind of fun. I'm going to share with you. And I want to ask a question. Do any of you, Kristin and Jeremy, do you know what this is?
It's a Humvee.
A Humvee, that's right. In other words, it's an HMMWV, High Mobility Multi-Purpose Wheeled Vehicle, colloquially known as the Humvee. So they were developed in the late 1970s, early 80s, because the U.S. wanted to replace like the M151 Jeep and the Gamma Goats from days of old. These things can go through mud, they can go through snow, wind, rain. I mean, there's stories you could read about these being used in whether it was Vietnam or into Afghanistan, Iraq, where they took RPG hits, IEDs, and somehow made it back behind friendly lines. And the question is why? It's because it was designed to be able to do that. They've got a special type of like rear differential, and it's just uniquely designed to be able to navigate you back home safely. And the question is, what type of portfolio do you have? Is it one that's more like a sports car? You can only take it out during certain times of year as long as there's not snow, ice, wind, or rain. You can utilize it. Or is it something that's more of an all-weather type of approach where no matter what happens, you're at least going to make it back home safely? That's the type of portfolio we think that folks heading into retirement should have. That's the types of portfolios that we strive to design at our firm with our experienced advisors at Stonebridge. And if you're wondering what type you have, not only should you go to stonebridgeriskquiz.com, you should also call the number that'll appear on the bottom of your screen and give one of our advisors a call and just get a second opinion. You can't get a second opinion from the person that gave you the first opinion. Give us a call today and we'll give you that analysis to find out the type of portfolio you have and make sure you have more of the Humvee approach than you do the Mazda Miata approach.
Very well said. I think a lot of viewers watch the show just to kind of see what awesome analogies that you guys come up with. So
that's why I watch it, because I don't know.
Right. Tim, Jeremy, thank you so much. But Tim could not have said it better. If this is resonating with you, or if you're already working with another financial professional and they are not having these kinds of conversations with you, you owe it to yourself to get that second opinion. And the team of Stonebridge Wealth Systems would love to be able to provide that for you in the form of your very own complimentary written financial plan. 866-256-7778 is the number to call to schedule yours. Or if you'd rather connect online, simply grab your smartphone, just click that QR code that you see in the bottom right-hand corner, and that will get you connected as well. We will continue this conversation on risk buckets and making sure that you are taking on the appropriate amounts of risk for your retirement right after this.
I own a motel I was able to buy out of college. When I actually ended up buying the motel, I was leaving. I had just passed the life and health license, and I was gonna sell Medicare supplements and long-term care. I told the owner of the motel that, hey, I'm gonna be leaving. I was giving him a 6 months heads up that, hey, I'll train whoever you wanna bring in. He said, I'd actually rather sell you the motel than bring in a new manager, because he never showed up. So he didn't have to do anything. It was kind of like an ATM for him. And so, you know, when you own your own business, there's a lot of people that got to be paid. There's marketing that has to be done. There's a lot of different dynamics that go into running a motel. It actually taught me to think outside the box a little bit. And so I started looking around, what are other things I can do? Because I really liked helping people. I liked solving problems for them. And there's a big difference between selling something and actually finding solutions to problems. When you're thinking about personal finance and managing somebody's retirement for them, they've worked for 40 years saving all this money, and now they're retiring. They're turning this over to you to take and run with it. So it's a big deal. I think we can always do stuff better. There's always room for improvement. And so I want to read as much as I can. I want to study as much as I can so that I can do a better job for my clients, which they're counting on me to get the job done for them.
Welcome back to the Retirement Compass, where today Tim, Jeremy, and I are discussing having the appropriate amount of risk in your retirement plan. And there are so many risks, as we said up front of the show. No investment is immune from risk. We've got risk whether we're in cash, whether we're in the stock market, and everything in between. But the key is you want to make sure that you have the appropriate amount of risk. So if you're just tuning in and joining us today, we're sharing with you an awesome resource that you can utilize completely for free. We invite you to visit StonebridgeRiskQuiz.com. You can also get there by scanning that QR code. This is a quick online interactive assessment. It takes about 2 or 3 minutes to complete, which will give you a really good look at where there might be a discrepancy between how you're currently invested and what your actual risk tolerance is. So important to know that information. This is a lot of what you do for folks when they come in and meet with you too, is making sure that there's an alignment there, because we often find there's a misalignment. So let's now talk about the 3 risk buckets, because this is something that you guys are very passionate about making sure folks understand. And so Jeremy, what is the first risk bucket?
So if we could pull up the risk buckets, we actually have a slide that we can show. So on the left-hand side of your screen, you're going to see the low to moderate risk bucket. And we call that the safety bucket. That's a bucket where we want to have our emergency funds. We want to have like a car fund or vacation fund. The point is we don't want to risk our principal. And realistically, we're looking for short-term liquidity. So for example, I'm not as concerned about the return on that bucket as much as I just want to provide the safety of principal.
And the accessibility, being able to tap into it if you need to.
Yeah, so those are the 2 criteria that we have for that bucket. It has to be safe. And by safe, we want to not have our principal at risk.
Right.
And the second thing is it needs to be liquid. Yeah. Kind of to your point.
For sure.
And one example of one of the stories that we had somebody come into the office, and she had talked about safe buckets and different risk buckets with her advisor. And her advisor had put her in a variable annuity for her safe money.
Oh my gosh.
And so, as you can imagine, a variable annuity, what does it do? It ties up your money, right? There's usually a surrender period with that. It could be 3 years or 5 years or 7 years or 10 years. But it's also very much at risk.
Yes.
I was going to say,
fails
so
both the tests.
it fails both the tests because it's variable, which means
Right.
her principal is not protected, and she can't access it.
Right.
Talk about a huge misalignment.
Yeah, so it wasn't even close to hitting the mark.
Right.
So yeah, that was a gigantic
But
problem.
I'm sorry not to go on this rabbit hole, but probably the reason why this person sold her that was maybe that's all they had access to, and there's often huge commissions associated with a variable annuity. But talk about a misfit.
Yeah, absolutely.
Yeah, okay. So obviously that was not the right tool for the job with that bucket, but how much money do you often recommend should be in someone's safety bucket, and where is the right place to put it if it's not something like a variable annuity?
Yeah, you're gonna like this answer, Kristen. It depends.
It depends,
right?
Well, like
It
most
depends.
things in financial
Yes.
services.
An attorney or something?
Yeah.
You're not.
I need you to
Clear.
sign. No, so it does depend, but usually what we talk about for this bucket, we want to have 3 to 6 months worth of we call it an emergency fund. It's going to be money that I can use to pay my expenses if I lose my job or if I have a major expense that it was unexpected. You know, if my washing machine goes out or if I need to replace a furnace or if there's something that happens that is unexpected, that's what that emergency fund is for, really. Now, if, kind of to my point on the job security or losing my job, if that's at risk, if you think that you're at risk of losing your job, we would probably want to go to a range of 6 to 12 months worth of expenses rather than 3 to 6 months worth of expenses.
Right.
So again, it's not a one size fits all. But if you have, a lot of people use this type of a fund or this bucket to save for a car fund or something like that they know, I know I've got this expense coming.
Right.
So I want to start putting that money in. Some people call it a sinking fund. In our office we call it sinking funds when we know we're going to hire people. We start putting a little money aside so that we can start, have that nest egg, or if you want to think of that, not nest egg, but more of a bucket there of money that we can go pay that expense with.
Yeah. Otherwise known as the Life Happens Fund.
That's
too,
right.
I mean, gosh, last year, right at on New Year's Eve, our oven broke and then our fridge broke. It was like, all right, we need all these new appliances, bam, and when it rains, it pours, right?
It always happens that way.
Yeah,
And you probably needed new tires at the same time,
Probably so, yes.
Well, it usually comes in threes, right?
Yeah, that's so
Our
true.
neighbor called on Thanksgiving Day and he said, our oven is not working, our microwave is not working, and our dishwasher is not working.
Oh, gosh.
Sounds good.
Yeah, and I think the year before it was a refrigerator, a washing machine. I can't remember what it was, but
Yeah.
it's like it always comes in threes.
Yeah, so you got to have enough set aside for all of that. And just because you retire doesn't mean that life stops happening, right? Okay, so now let's talk about the next bucket that's up for discussion.
Yep, so we'll pull the buckets back up here on the screen. We've got green next, which it's dual purpose, to be honest with you. It's either income or it's growth without risk. So I know that sounds confusing, right? It's like, tell me, Tim, explain to me, how can it be dual purpose? It's one or the other. Yeah, it's one or the other, but here's what we can tell you. According to a recent report from Ernst & Young, if you start allocating money to that safe bucket, we call it a volatility buffer. So they did a study and they said, hey, we want to maintain a 90% probability of success in retirement. And we're going to start with investment only, so just in the stock market. And then we're going to say, what if we put 10% of our money into this growth without risk bucket or use it for an income strategy? 20%, 30%, 40%, 50%. How does that change not only our probability of success, but if we wanted to maintain 90%, more importantly, how does it change the amount of income that we could receive during our retirement years? Could we live a more comfortable lifestyle, or would it be more of a belt-tightening lifestyle? And how much money would be left over for beneficiaries? And what they found was kind of shocking. The more money, as they got to like 30% in that bucket, as they went up from 10, 20 to 30, the more money they started to allocate to that safe bucket and have a volatility buffer, the higher the amount of income, sustainable income, that could be drawn from the portfolio. Well, that seems counterintuitive, because in a safe, in an income bucket or a growth without risk bucket, like that middle green bucket, you're going to get a lower return, most likely long term, than if you put your money in equities in the stock market. But that's why we got to go back to the fact that it's not just about the growth side of it. Growth is great, but also avoiding large losses is even more important. And so the reason why it shows a better outcome is because if you're subject to what we call sequence of return risk, which is you're pulling money out when the market's down,
right?
You're locking in those losses. If a portion of your money is allocated to a growth without risk bucket or an income bucket, it's going to grow more than the safety bucket. It's not going to grow as much as the growth with risk bucket that we'll get to in a second, but it's going to be secure, and it's going to be at least have liquidity provisions. And so in those down years, what do? If you need money, you take it from the growth without risk bucket, and you allow your at-risk resources to recover. So you're not locking in those, like you're not, buying high and selling low, right?
Yep.
And all of a sudden you get either the ability to take more income or have your income simply last longer in retirement, so more confidence.
Yes, it makes so much sense. And it's just interesting to me that concept doesn't get talked about a lot when you're in the accumulation years, because it doesn't apply when you're working and saving and all that. Yeah. But this is that important transition that happens as you are pivoting towards retirement. So I know we only have a few minutes left in this segment, but Jeremy, that leaves the risk bucket, right? Growth with risk. Talk about that one.
Yeah, so if we could pull that slide back up. So we've got the red bucket on the right. So this is, as you mentioned, it's the risk bucket. So this is what we want to have. We want to be looking for a lot of growth out of this. So we would have investments like individual stocks, ETFs, mutual funds, money that we know that's going to fluctuate. It's going to be volatile, but if we have the right allocation, to Tim's point, we can, I guess, weather the storm, if you want to think of it that way. And so that's what that bucket is for. And so if you're thinking of, if you're trying to figure out where is my money at, if I'm looking at my investment statement, it's not red or orange, green, and red buckets, right? It's ETFs, it's stocks, it's bonds, it's just all mashed together. Together. And so if you're not sure, if you're sitting at home watching the show right now and you're not sure where would my investments actually be allocated, that would be a great time to give the number at the bottom of the screen a call, to sit down with our experienced advisors and walk through what your investments look like and how that portfolio could be optimized to reduce risk and increase performance. So.
Awesome. Well, I'm glad that folks have you as a resource, because again, it's a lot to navigate on your own, but this is something you do for folks day in and day out. And so if this is resonating with you, we encourage you to reach out to the team of Stonebridge Wealth Systems and schedule your time to receive your very own complimentary written financial plan. 866-256-7778 is the number to call to schedule yours. Or again, you're welcome to scan that QR code and that will get you connected as well. We'll be back with more right after this.
Hi, I'm Jeremy Gove with Stonebridge Wealth Systems. When markets are up, risk feels exciting. When they're down, it can feel overwhelming. That's why it's so important to know your personal risk tolerance before the next market shift, so you can make smarter, more confident decisions. The Stonebridge Risk Quiz is a fast, easy way to understand where you stand. Most people don't realize how much risk they're actually taking until it's too late. Are you more conservative than your portfolio? Or maybe you're not taking enough risk to grow your savings. In just a few simple questions, the quiz gives you a personal risk score you can compare with your current investments. It's one of the smartest steps you can take to bring clarity and confidence to your retirement strategy. Scan the QR code or visit stonebridgeriskquiz.com and take the free quiz today.
Welcome back to the Retirement Compass, where today we are posing the question, are you taking on too much risk or maybe not enough risk with your hard-earned money for retirement? As we said, no investment is immune from risk. It's just a matter of what kind of risk. Where your money is what it's subjected to, right? And this is why we talk about the risk buckets, and you guys have done a great job of detailing that. What metrics do you want to share with our audience that they need to understand that can help them really not just determine their risk tolerance, but most importantly, their risk capacity?
You know what my least favorite class was in college, like generals in the business college? It was statistics. So let's talk about some statistics.
All right, let's do it.
So I'm going to motor through these. One of the ways that you can tell how much risk you're taking is through something called standard deviation. So it's probably the most often cited or referred to risk statistic. And it's used to determine the consistency of an investment's return. So I'm going to pull up some examples here. So I've got a few funds that I'm going to go through here. We've got there we go, thank you, Invesco Small Cap Fund, we got First Trust Capital, and we got a Vanguard Fund. So let's blow through those. Look at the right-hand side, okay? 10-year average return. It's pretty similar across all of them. So if I just looked at the surface, I say, well, which one am I going to invest in? And this is not specific advice. These are just random funds that I pulled off of a site called White Charts. Look what happens when we throw in the standard deviation right next to those returns. So if I only look at return, it looks the same. Standard deviation, a total different ballgame. So what our learning principle here is on today's show is looking beyond average return is critical for a consistent investing experience, because the top fund, the Invesco Small Cap Fund, is going to fluctuate much more than the fund in the middle, the First Trust Fund.
Yeah, the higher the standard deviation, the higher
more the
the
volatility,
fluctuation, right?
Because it's basically saying like how much does it average, or how much does it vary from its average?
Right.
Well, so one standard deviation, that top fund might be up 34%, but then on the downside, it's going to be down, double digits, right? So, whereas the middle fund, it might only be up 24%, so 10% less, but on the downside, it might only be down 4%. So that's the principle we're trying to get at. Now, I want to build on standard deviation just real quickly and go to Sharpe ratio. And again, for my propeller heads out there, this is awesome, and for everybody else, it's like, okay, let's put Tim on mute. Here's the components of a Sharpe ratio: the average annual return, risk-free rate, and standard deviation. So, okay, we just calculated average return. We grabbed that from Y charts. We have standard deviation. We calculated that on the last slide. And now we're going to take the risk-free rate. We're just going to say that's a short-term U.S. government debt obligation. Here's what that's going to tell us. If we look at the formula, which is the next slide, it's actually pretty simple. You just take average return minus risk-free rate divided by standard deviation. Now, why is all this important? Because if we go to the next slide and we show what Sharpe ratio actually is, there we go. The first fund with the highest return also has the highest standard deviation, and the Sharpe ratio is the lowest. So now, the lower the Sharpe ratio, the worse. We want the highest number. So all I'm trying to show you here, folks, is there's more to it than just return. If all you look at is return and all you ask your advisor about is return, you're missing a huge portion of what makes your portfolio more like the Humvee or more like the Miata.
Yeah. Well, and I would also add that the right question is not as why, what, not focusing, not what on is, let me get this out, sorry. Not on what is my average annual rate of return, but rather what is my yield, meaning how much money is actually in the account, right?
Exactly.
Because you could say average annual rate of return, but if you have less money in the account than when you started with, that's the problem.
Yeah,
Absolutely.
exactly.
Yeah.
Well, and that's what most people look at with their 401ks. If you ask them why did they pick those funds that they're investing in,
That's a good point.
they see the return,
Correct.
That's it.
and that's what they choose.
Yes.
But the return is showing what it did in the past, not necessarily how it's going to perform in the future, of
Exactly.
course, right?
Exactly. Well, you've brought up a lot of good points that I think a lot of people probably haven't focused on to date. What do you want to leave our viewers with as we wrap up this conversation?
Like I say, the way I see it, you have three options, folks. You can just listen to this information and say, oh, that was kind of interesting, and then go about your day and keep going the way you're going. You can go to do all the research we did and do it yourself. There's also another option. You can call that number at the bottom of your screen, and we'll look forward to seeing you soon.
Wonderful. Tim, Jeremy, thank you so much. And thank you for watching. 866-256-7778 is the number to call to start your complimentary written financial plan today. Thanks for watching. We'll see you next time here on the Retirement Compass.